If you're a real estate investor like me, then you've probably realized that your cash flow isn't everything that it was cracked up to be. Now, you understand that there's more to real estate investing than just cash flow, but that isn't what puts food on the table. So in this video, we're going to be going over how you can use business acquisition as a way to not only get the cash flow that you need to support the lifestyle that you want, but also be able to magnify the returns that you're going to be able to get out of your real estate investing. I'm James Masotti. I'm a real estate investor, the owner of Our Team Accounting and Crystal Clear Property Management. And on this YouTube channel, I am passionate about helping real estate professionals and entrepreneurs achieve their personal and professional goals through intentional financial planning. Let's go ahead and dive right in. All right, so to start off, we're going to talk about why is it that real estate isn't as good at generating cash as we're sometimes led to believe that it is. When it comes to real estate investing, your cash on cash return, which is a measure of how much cash that you get back out based on how much cash that you put into something, can ultimately be anywhere from negative to infinity. And guess what? That's a really wide range. And so let's talk a little bit about both of those extremes and why there's different opportunities for real estate to come in anywhere in that spectrum. Let's start on the high side of things. So on the high end of things, on the infinity end of returns that you could possibly get from a cash on cash perspective out of real estate, we have the BRRRR method of real estate investing. And what the BRRRR method is the buy, rehab, rent, refinance, repeat model. And this model, if executed properly in the proper market cycles, basically means that you can buy a property and go through all of those stages and then do a refinance and be able to pull 100% of all of the costs that you had out of pocket back out of the deal. So you put money in, you get all of that money back out, which basically means that any additional cash flow that is thrown off by that property is generating an infinite return because your money is basically printing an infinite amount more, and every dollar that you make is more than you had before. So that is the best possible return scenario that anybody could possibly imagine. On the flip side of things, you're going to have a negative return. And let's use house flipping as an example of that. There is the possibility when doing house flipping that you are going to go ahead and buy a property, and then it's going to cost you more to rehab that property than you anticipated it was. And it's going to take you longer to rehab that property than you anticipated it did. And then you're going to sell that property for a lot less than you anticipated that it did. And when you compound all of these things, it's very possible that at the end of the day, you're going to sell it and you're actually going to lose money on the deal. And so this basically means that you put in a certain amount of money and then you had to put in even more money just to get rid of this particular deal. And that would be considered a negative cash on cash return because you actually had to put in more money in order to get rid of something. And so that is on the worst end of the spectrum compared to our BRRRR method. But in reality, real estate investing is going to come in somewhere between those two scenarios. In general, real estate is going to generate somewhere between a 5 and a 25% return on your cash. Hidden expenses can really eat into your cash flows as a rental property investor. So that's why I've gone ahead and shared on the screen what the percent of my rent these expenses were for one of my real estate entities over the last 7 years, just to give you a bit of a perspective on, how much that you could end up paying on all these different areas. And for some of you, you may not have realized that these would even be a thing. That being said, real estate is often referred to as a get rich slow form of investing. And the real reason for that has to do with the fact that generally speaking, when you would acquire a property, your mortgage is somehow fixed, right? You fix the dollar amount you paid for it, and there's a good chance you at least have a fixed percent interest rate, at least for a period of time. In some commercial loan products, the rate either changes every year or maybe it changes every couple of years. But generally speaking, you have these fixed periods of interest where your costs that you have to pay for the property are not necessarily going up every year. That being said, over time, rents do generally go up. Now, so do some other things like property management expenses or, the costs for repairs and maintenance and things along those lines. But you do start to oftentimes create more of a gap because rents will often, increase at that same percent. But because you have a fixed portion of your expenses or a relatively fixed portion of expenses from your mortgage, you're going to start seeing a bit more spread. In addition to that, your property is probably going to be increasing in value as well. Over time, again, this is always like market to market, slightly independent, dependent and things along those lines. But on the broad scope, you're going to see between 3 and 5% property value growth, while at the same time, you're paying down that mortgage. And so I've shown on screen the reason why, as your property value is going up and you're paying the debt down, you're going to see basically the gap between those two things is growing significantly. And that represents the equity or the value of your assets. And so you can see that over time, you can create quite a big spread. And along those same lines, you could similarly kind of chart a graph like this for your rent growth compared to your expenses. And basically, once that mortgage is paid off, that entire mortgage payment now starts to go into your pocket. And then everything else, you're still paying that same amount. And so your cash flow will significantly increase, as does your equity position further down the road. And so even if you're not getting significant cash on cash return every single year, you are in the long run, 15, 20, 30 years down the road, going to see really great, strong benefits from your real estate investments. Now, we just mentioned that that's 10, 15, 20, 30 years down the road. And so you're going to be asking yourself, how does that help me now? And that's why real estate is a really great long-term play, but it's not the best way to generate short-term cash. Unless you're pursuing a more active form of real estate activity, such as being an agent or house flipping or wholesaling. But understand that those require a lot of active work. When you stop doing it, the money goes away. And versus when you buy rental properties, like you get a tenant in there, they should be paying their rent every single month, even if you do nothing else. And so that's part of what makes it more passive, is when you set up that portfolio, the rent collection process, yes, you have to work and do the property management part of it if you don't have a third-party property manager that you're using, but the rent basically is just going to keep coming in. But that's also the reason why, even in the eyes of the IRS, wholesaling and flipping and real estate agents, those are all considered active sources of income and are taxed as active sources of income, versus if you do residential property renting, or if you were doing even commercial rentals, like those are considered as more passive holdings and are taxed as passive holdings as well. Now, on the flip side of that, you have businesses. And businesses actually generate really strong cash on cash returns. Now, while it's going to vary from industry to industry, a good, healthy business should have net margins after paying its owner a reasonable salary of somewhere between 10 and 25%. But I would say that somewhere between 12 and 18% is probably more the norm. Now compare this to the 5 to 8% that we said you're going to be able to get out of your real estate. Then what you'll notice is that as a business, you're going to be getting between 3 and 5 times more cash flow out of your business than you would out of your real estate. And now we mentioned that's for healthy businesses. So assuming that your business is already paying the owner a reasonable salary, whether that's in the form of wages or distributions, what we're really talking about here is that true bottom line net cash that is available to the owner to make a decision on whether they're going to reinvest that back into the business or whether they're going to take that out for whatever purposes that they so choose to use it for, such as maybe buying real estate. Since businesses are considered active sources of income, they're a really great way to be able to deduct a lot of expenses that you can have in your personal life and that are legitimately related to being able to operate your business. So these could be things like portions of your vehicle, portions of your house that maybe are used as a home office. If you need to have a cell phone for your business and internet for your business and things along those lines, those are all reasonable expenses that you can run through your business because you need those to operate your business. On the flip side, with real estate, those are not things that you need to operate a passive residential real estate portfolio or even a lot of other forms of passive real estate investing. So you don't get to take advantage of those the same way that you do in a business. But that said, there are other tax advantages such as depreciation and some other things that you're able to take advantage of that make real estate also have some tax advantages. And so the combination of having a business where you can really optimize kind of your expenses to reduce your business liabilities in terms of a tax perspective. But then once you generate your net income, real estate gives you some other opportunities on how you can shelter some of that to kind of maximize the holistic approach of owning real estate and business together. Doing your company's accounting on your own can be overwhelming and time consuming when you're trying to run your business at the same time. If you're interested in learning more information about our do-it-yourself and done-with-you group coaching programs, or if you're interested in taking your services to the next level with our fully outsourced accounting solutions, getting help with implementing Profit First, or even fractional CFO services, go ahead and scan the QR code on your screen or click the link in the description below to find out more about these programs and how we can help support you. So now let's talk about the power of combining real estate investing with business ownership. And we've already talked about the cash flow implications of why cash flow is better out of a business than it is out of real estate. But the flip side is true when we talk about wealth generation. And so when we talk about the value of a business and what it could sell for down the road and how to increase the value of a business compared to what we can sell real estate for compared to what it generates, real estate is able to be sold at a much higher multiple. So let's break that down. In the United States, if you have a small business that is generating somewhere below $1 million of seller's discretionary earnings, or SDE, then there's a pretty good chance your business is going to sell for somewhere between a 2 and 5x multiple of that SDE. And so basically, if you had $1 million, you would be selling it for somewhere between $2 and $5 million. Now let's compare that to real estate. When it comes to real estate is generally sold on what is called a cap rate. And a cap rate is basically, if you reverse engineer it, the average cap rate in the US is 5%. And a 5% cap rate is the equivalent of a 20x multiple on the cash flow that a particular piece of real estate is generating. So understanding that there are certain markets that have lower cap rates and therefore trade at higher multiples, and there are markets where cap rates could be 10, 12, 15%, and therefore are below that 20% multiple. 5% is the average across the US. And so real estate, when it comes to that return on the cash in the long term, is going to basically create more wealth for you because you spend all this time generating a certain amount of cash. You want to position that cash into something that's going to have the best long-term generation. And so when we're trying to balance these two things out, business acquisition is a great way to generate cash when you need to be creating cash flow to support your lifestyle that you want to have. But once you've met those lifestyle expectations and you start to have excess cash, it's a great way to build your wealth on a more efficient way is to take that cash out of your business and start buying real estate with it, because those multiples that we just talked about, those exit multiples, are significantly higher on how you can multiply in real estate than they are in business. Not only is there that gap between the business and real estate multiples, but let's also just talk about the liquidity and the marketplace for these two assets as well. In general, when you decide that you want to go and sell your business, there is a marketplace for that. There are business brokers, there are websites where you can list your business for sale, but the entire process of trying to sell your business is limited to the environment of people who are interested in buying businesses. These could be competitors, they could be people kind of coming into the market, they could be people from outside your market that are looking for an opportunity to get into your particular market. But at the end of the day, you're limited to this pool of potential buyers. And not only are you limited to this pool of potential buyers, but the actual process of seeking offers and getting offers and then going through the entire due diligence process with the bank is actually kind of complex because there's so many moving parts to businesses, whether it's looking at their financials, the assets they have, valuing those assets, getting appraisals. You have people and the complexity of the relationships that are involved there. And there's a lot more moving parts with being able to sell a business to a much smaller potential pool of buyers. Furthermore, let's talk about additional business acquisitions. So if you want to get into a position where you say, hey, I do actually want to generate additional, cash flows, one of the things that banks absolutely love to see is that you have bankable assets behind you when you're going and getting these business acquisition loans. And one of the key forms of assets that banks love to see is that you have real estate that you can that they can sink their teeth into, that they can put liens against to help collateralize the loans that they're underwriting. And so when you go through this process of taking your cash flow to buy real estate and then building up equity in that real estate over a period of time, and then you're able to re-leverage that real estate to help you go buy more businesses, you can see how we're able to create an amazingly virtuous flywheel where the two things really just play off each other and allow you to kind of grow and magnify both your ability to generate cash as well as your ability to generate wealth in a really significant and meaningful way. So now let's go ahead and start talking about the step-by-step process that you can take when trying to figure out how you're ultimately going to integrate these two strategies together. Like all things, step one is coming up with a plan. And so understanding where you're at in this process of, do you already have a business that's generating cash that's going to allow you to be able to go buy real estate? Or you may be in a position where you've had a W-2 job and you've been able to acquire a few pieces of real estate that you now want to leverage and being able to go buy a company. These are both, ways that you can go about it, and everybody's going to have their own starting point, but being able to have a plan and know where you're at and when you're going to go and accomplish those things is going to be really significant. When it comes to making a plan, though, one of the things that, has always struck me as something that, I get wrong a lot, and I've seen this with a lot of other driven investors and business owners, is that we very frequently overestimate what we can do in a day or in a week, and we significantly underestimate what we're able to do in a year or 5 years. So there's a great example of this from Mr. Beast, where he recorded a video from his early days on YouTube and said, in 5 years, I better have 1 million subscribers. And he was like, man, in 5 years, he's like, I might be dead, but if I'm not, I better have at least 1 million subscribers. And he ultimately ended up having something like 40 million subscribers by the time that 5-year mark hit, right? And so when we're thinking about what we want to be accomplishing and what we can, the stepping stones that we're able to make for ourselves, it is important to understand it's going to take time to build momentum. But then as we build momentum, we have the ability to make much bigger impacts than we often are able to plan ahead of time. So if this is something that you're struggling with, I really encourage you to check out the book 10X is Easier Than 2X by Dr. Ben Hardy and Dan Sullivan, because this really gives you a kind of that understanding of why there's this dynamic at play and where you can really up level, your ability to make plans. The next thing that you're going to need to figure out is getting access to cash. So if you're a business owner, you're going to want to give some thought to how much of your free cash flow are you going to be able to allocate to being able to buy real estate, or potentially even look into getting a line of credit from a lender to be able to leverage the bankable assets that you have in your business. That gives you some what we would call dry powder to be able to go out and make some of those acquisitions and then be able to refinance them into longer positions and basically use your existing business as some of that initial financing as your initial bank. That's a great way to be able to take advantage of, again, the cash flow and the assets that you already have to get into real estate. If you are currently a W-2 employee, then one of the key things that you definitely want to be asking yourself is, are you securing your job? And do you like your job? there's not necessarily anything that says you have to go and become a business owner. There's a lot about business ownership that, is not for everybody. And I'm not one of those people who says that, having a W-2 job is more secure than being a business owner, because I've been laid off from W-2 jobs before. And so while it can feel secure in the sense of like, oh, I show up to work and I get a paycheck every day, you never know what's going on in the background with the health of that organization, or what kind of major event's going to happen that's going to result in them needing to do a downsizing. And so, but if you go and buy a business, a lot of times you're putting a lot of your personal assets on the line, and you've got a lot of people who are responsible to you, and your ability to generate income is now entirely reliant on your ability to go out there and continue running and or growing the business that you purchased. And so reflect on kind of where you are and whether or not, you're going to go take that and be able to buy real estate with that excess, or do you looking to get out of your job? Then you're probably going to need to buy a business, because as we mentioned, real estate is a get rich slow process, which means you're not generating a lot of cash flow. And so what we want to be looking at is your ability to achieve, that financial independence concept. And that's really about having more cash being generated than what your lifestyle expenses are. And so really getting clear on your lifestyle expenses, then that'll tell you, okay, what kind of business do I need to buy so that I can buy it, I can continue operating it, and be able to, support the life that I have. While then as I grow it and I start to generate cash that exceeds that, I now have resources that I can then use to go buy real estate. And so understanding those plays is going to be, again, critical for you. If you don't have that cash flow, then you have a couple of options available to you. You could go to private lenders to help you buy real estate, or you could potentially even get equity investors to help you buy real estate or to buy businesses. And so if you're not wanting to exit, the corporate world, but you also don't have the resources, there are some other options that are available to you. And if you don't want to go that route, but you're still needing to generate some additional income, then definitely take some consideration into some, building a side hustle or building a side income rather than starting something from scratch, and be able to take that time and reinvest, and kind of have to work that hustle and that grind for a period of time so that you can eventually dial yourself back from those activities and be able to direct them into more targeted efforts from an acquisition standpoint. So now that you've got access to cash, the next thing that you're going to need access to are assets. And so whether you're looking to buy businesses or you're looking to buy real estate, having access to those things is obviously going to be really critical. And one of the pieces of information that I found most interesting as I've gone down this journey of both real estate acquisition and business acquisition is that once you actually get your first deal done, a lot more opportunities start to come your way. And so being able to get access to those deals and understanding that initially, your first deal is probably not going to be a grand slam. And so it's really rare that your first at bat should be focused on anything other than getting a base hit. Just get a single, get on base, because when you do that, that's when the magic starts to happen. That's when you start to learn how to find deals, who's doing deals, where you can get financing. You have credibility with lenders because you've, done something and you've exited compared to somebody that they're not clear on. And so you start to build the ability to have people feel comfortable bringing opportunities to you. And then when you submit offers on opportunities, whether those are on market or off market opportunities, people are going to take you even more seriously because you've actually accomplished something. So again, in order to get access to these, a lot of times you're going to be starting out with, communicating directly with brokers, whether those are real estate brokers, whether those are business brokers. You're going to be looking on, the regular listing sources. So for real estate, that could be starting out with things like Zillow and Redfin. On the business acquisition side, you could be looking on websites like BizBuySell or BizQuest. And really, you're just kind of going through and you're looking at, okay, this is what retail is. This is what below retail is. This is what I could pay for this type of business or that type of business. And you're just getting a sense of what's available out there. And you're putting out a lot of inquiries. Again, understanding that you're going to hear a lot of no's before you're eventually going to hear a yes. Other things that you can do is join networking groups. There are real estate investor associations all across the country. There are also groups of small business acquisition entrepreneurs and ETA, Entrepreneurship Through Acquisition, entrepreneur groups, and you can find them on Meetup. You can go on websites like biggerpockets.com for real estate investors or searchfunder.com for folks who are looking to acquire businesses. And you can find people interested in the same industries or the same markets that you're interested in or the same asset class that you're interested in. And you can start to make connections with all the different people that you need to make and potentially even get access to deals through those communities and folks that you're going to encounter. Now, as you start getting access to these assets, as I mentioned, you're going to get a lot of no's before you get yeses. And that's why the next step to this process is the practice process. And so basically what I mean by practice is you're going to need to analyze a lot of deals that are not going to be good before you're able to find a deal that actually meets the majority of the criteria that you're looking for. Whether you're buying real estate or you're buying businesses, it's really hard to find something that's going to check 100% of your boxes. So there is an element of what are your non-negotiables and then what are your I'd like to have kind of list, and being able to balance those things out is really, really important. So if you're looking at buying a business, then again, I mentioned the Biz Buy Sell and BizQuest. Go on those websites, get an idea for either businesses in your area or search. You can filter in those tools by different industries and go through and look for descriptions of businesses that look like they're interesting and are in price points that you think you might be able to afford, whether you're bringing all of your own resources, you're tapping into your retirement account to be able to do an acquisition through a ROBS plan, or maybe you're planning to raise equity from investors to be able to go buy a business. But what you absolutely should do is kind of having already made your plan and knowing what you're doing is be requesting those CIMs or confidential information memorandums, CIM, that's what we call them. And because what you're gonna get is you're gonna get a better profile of the business as well as access to their business financials to start looking at how are these things being presented. These business brokers are marketing professionals, and so they are intentionally trying to make these businesses look good so that they can generate interest and be able to sell them. That being said, they're not always that great. And the vast majority of businesses that get listed for sale are ultimately not going to sell. And so being able to request all of that information and start figuring out what works for you and doesn't work for you is a great way of getting practice reps to be able to identify what kind of business you would be interested in actually making an offer on. On the real estate side of things, I strongly recommend that you go check out the website BiggerPockets and pay to become one of their pro members. Now, I'm not an affiliate there, so if you go register, I don't get anything for that other than I can say as somebody who is a starting investor and paid for that pro membership, one of the best things that they have is their calculators. So depending on the type of real estate that you're going to do, they have built-in calculators where you can go in and you can plug in all of the numbers that are there, and it will output for you what you need to be paying for a particular property or how much money you're going to make or how much money you're going to lose. And when you do that through looking at properties that are on the MLS or things that you've gotten because you've gotten connected with other real estate investor groups and you're getting access to off-market listings from wholesalers or whoever it might be, you're able to actually build out like a catalog and a library of resources that you can save in your BiggerPockets profile. I just went in and looked at mine recently, and there's still analyses that I had done 8 years ago saved in that particular profile. So again, it's a great way to be able to just look at a lot of deals, with most of those being like, hey, this is they're asking $80,000 for this, and I can't pay more than $60,000. Great, make the offer, see what happens. I had one property that I did ultimately end up buying where my offer was well below their asking price. But after the property had been listed on the market for like 3 months, they eventually came back and accepted our offer because we were the only ones that had actually made them a serious offer. And so again, you never know what's going to happen. So when you do your analysis and you come up with your number, whether it's real estate or a business, when you like it, go ahead and write the offer because you never know what's going to happen. Another piece to the practice process that I strongly encourage you to do is to go through a self-assessment process. And I really like the framework that Walker Deibel presents in his book, Buy Then Build. So this was specifically around business ownership, business acquisition, but I think there's applicable components to this from a real estate acquisition perspective as well, and understanding kind of how active or passive and different types of asset classes you want to have. And so the first part of that analysis is kind of doing a SWOT analysis. So if you're not familiar with SWOT, it's SWOT, which stands for strengths, weaknesses, opportunities, and threats. And if you're not familiar with how to do one of those, you can go ahead and ask ChatGPT to help you with this. Great tools out there for being able to do one of these, but you're doing it on yourself, not on the business or the real estate that you're trying to do. You're doing one of these on yourself because you're trying to reflect on what are the things that you're good at, what are the things you're not good at, what are the things that you like to do, and what are the things that you don't like to do, so that basically you can get really clear on what type of a business should you be buying based on the strengths and characteristics that are going to set you best up for success. Another thing that he really focuses on in that book is your attitude, your aptitude, and your action-taking abilities. So these are things that you really want to be able to dig in on to understand, are you able to go into a turnaround or a high growth situation? Can you stomach, seasonal aspects to business? How are you going to react in all of those different kinds of scenarios, so that, again, you're able to kind of get a sense of what types of businesses that you're ultimately going to be interested in running. And these are going to help you get the right kinds of questions to ask brokers and to ultimately ask the business owners when you get to having those conversations. And our final step in the process is to simply execute and go buy something. And now the process for buying a business or buying real estate is super complicated all in and of itself. And so I am not going to be covering that in today's video. We will have future videos that go a lot deeper into how you actually buy real estate or how you actually buy a business. But just know, after you've gone through all of that and you've done all that planning, all of that research, all of that practice, at some point, you gotta actually do something. Otherwise, you've just been having fun in games. And if you just like doing all the analysis and hanging out with cool people, because I certainly like doing all of that, but doing deals is also really, really fun. And it's something that you'll hear a lot of great people talk about. There's a lot of great podcasts. I'm a big fan, for example, of the Bigger Pockets podcast, of podcast Acquiring Minds by Will Smith. And you'll hear all about the deal-making process. And so it's really great to go and do that. But then you get into the other part, which is also operating a business. And so there's also this whole space of, there's people who are really great on the acquisition side of things and running through all of this stuff. And then maybe they're terrible operators and they're not good at running businesses. And so understanding all of that about yourself, again, is super critical to this process that, again, we're not going to get into in today's video, but I wanted to take a moment to touch on that. We can do all of this stuff, but you do eventually have to execute, and then not only execute the acquisition, but then you have to operate your real estate and or your business when you actually go and take those next steps. So now that you're ready to take some action, we're going to go ahead and dive deeper into how to identify the strategy that's going to be best for you when it comes to buying real estate. So go ahead and click the video on your screen, and I will see you there.